Okay, so are you ready to like totally decode the world of investing?
Mm,
Well, get this.
yeah.
We're going to dive into some investing wisdom from over a century ago.
Wow, that's quite a while back.
Yeah, it's crazy, right?
Yeah.
We're talking railroad bonds,
Uh-huh.
real estate mortgages,
Okay.
industrial bonds,
Mm-hmm.
even good old-fashioned stocks.
Wow. The classics.
But the really interesting part is that we're not going to just like list the pros and cons of each.
Wait.
We're going to like uncover the core principles of smart investing,
Okay. Yeah.
the stuff that stood the test of time for
Right.
over 100 years.
What's fascinating to me is
Yeah.
that, even though the financial world has transformed so much since then,
Uh-huh.
the fundamentals of making smart investment choices,
Yeah.
they're surprisingly consistent, you know?
It's like opening a vintage treasure chest.
Yeah.
But instead of those gold doubloons, you find
Yeah.
timeless investing advice.
Yeah, exactly.
So where do we even begin with all this?
Well, I think the best place to start is understanding those
Yeah.
5 key factors every investor should consider.
Okay, so give me my compass points here.
All right, so first up, we've got safety of principal and interest.
Okay.
This is all about making sure that you get your money back, plus the agreed upon return
Right.
without any nasty surprises, right?
So this is like the bedrock of any investment.
Yeah.
If you're not reasonably sure you're getting your principal back,
Mm-hmm.
then you're basically gambling, not investing, right?
Precisely.
Okay.
All right. Next, we have the rate of income.
Okay.
So this is where you really look into that actual percentage return you're getting on your investment.
So two investments might both look promising on the surface, right?
Right.
But one might actually be putting more money back in your pocket.
That's right. Yeah.
Okay, got it. What's next?
Okay, next we have convertibility.
Okay.
And this is how easy it is
Right.
to turn your investment back into cash
Yeah.
when you need it.
Okay, liquidity.
Exactly.
Yeah. So some investments are like cash in the bank,
Right.
super easy access.
Right.
Others are more like owning a house,
Mm-hmm.
might take a while to sell.
Exactly, yeah.
Okay.
Knowing how quickly you might need access to your money
Yeah.
is really crucial in choosing the right investments.
I'm starting to see how these pieces fit together now.
Good.
What are the last two factors?
All right, so then there's appreciation.
Okay.
And this is, the exciting possibility
Yeah.
that your investment will actually grow
Right.
in value over time.
Well, that's the dream, right?
It is.
Just watching your money multiply while you sleep.
Yes.
But I'm guessing bigger potential gains
Yeah.
usually come with bigger risks, right?
That's a wise observation.
Okay.
For sure. And finally, we
Yeah.
have stability.
That's right.
Third. This is all about how well your investment will hold its value,
Okay.
even when the market gets a little bumpy.
Okay. So
Yeah.
some people are okay with a roller coaster,
Yeah.
while others like a nice, smooth ride.
Exactly.
It all depends on
Yeah.
their risk tolerance
Right.
and what they're trying to achieve.
Precisely. And that's where our vintage source material gets
Okay.
really interesting.
Okay.
Because it points out this classic mistake
Yeah.
that the average investor makes.
Okay.
And they compare them to a patient
Mm-hmm.
who goes to a doctor and demands medicine
Right.
without even explaining
Yeah.
the symptoms.
So I know that type.
Yeah.
Just want a quick fix, no understanding of the problem in the first place.
Right.
So how does that apply to investing?
Well, just like you shouldn't take medicine without knowing what
Yeah.
you're treating,
Yeah.
you shouldn't choose investments
Mm-hmm.
without understanding your own financial needs and goals.
So step one
Yeah.
is figure out what you actually want to achieve with your investments. Do you want to protect your money,
Uh-huh.
generate a steady income,
Mm.
or go for aggressive growth?
Yeah.
Got to know the answer to that
You do.
before even looking at specific stocks or bonds.
Exactly, yeah.
Okay, so once you have a handle on your needs,
Mm-hmm.
you can start thinking about spreading your risk, which
Wow.
brings us to diversification.
Yes.
Don't put all your eggs in one basket.
Right, exactly.
I bet our vintage source has a story about that.
It does. It
Well,
does.
lay it on me.
So it talks about a fire insurance company in
Yeah.
San Francisco
Okay.
that went belly up
Yeah.
after the big earthquake.
Oh, wow.
And the reason they failed
Mm-hmm.
is incredibly relevant
Yeah.
even today.
Okay.
They had all their assets concentrated
Wow.
in San Francisco real estate and businesses.
Okay.
When the earthquake hit, the very thing they were insuring against
Mhm.
wiped out their assets too.
Ouch. That's a hard lesson.
It
Is in
is.
what not to do.
Yes.
So spreading your investments across different types of assets,
Mhm.
different industries,
Right.
even geographic regions, right,
Yes.
can help cushion the blow if one area takes a hit.
Precisely. It's about building a portfolio
Yeah.
that can weather
Yeah.
different storms.
Okay, so let's say I've figured out my investment goals.
Okay.
I understand why diversification matters.
Mhm.
How do I actually go about
Yeah.
matching specific investments
Yeah.
to my needs?
Let's say you're dealing with a business surplus in that case.
Yeah.
Safety, convertibility,
Uh-huh.
and stability of price
Right.
should be your top priorities.
Makes sense.
Yeah.
Businesses need to be able to access their funds quickly, right?
They do.
And they can't afford to gamble
Right.
with essential capital.
Exactly. Now, if you're an investor who relies on the income from your investments to, say, cover living expenses, your focus should be on safety and a high rate of return.
Right. You need that steady stream of income.
Yes.
You got to make sure it's coming from a reliable source.
Exactly.
Okay, so income-focused investors
Mhm.
need a different strategy than a business would.
They do, yeah.
So what about the folks who don't need their investments for immediate income?
Right.
What should they prioritize?
So for them, the priorities shift
Okay.
to high return and the prospect of appreciation.
Okay.
They have more flexibility to ride out
Right.
market fluctuations,
Yeah.
and they can afford to take on a bit more risk
Okay.
in pursuit of those juicy gains.
Of course.
Yeah.
These are just general guidelines.
Of course.
The specific investments are going to depend
Yeah.
on your unique circumstances and your risk tolerance.
Absolutely. It's all about finding the right fit.
Okay, so let's get down to brass tacks here.
Okay.
Let's explore some of these investment types.
Right.
We've got a whole list here,
Yeah.
starting with railroad bonds.
Okay.
What made them stand out back in the day?
Well, railroad bonds were known for being highly convertible.
Okay.
Easy to buy and sell,
Right.
partly because there was already a really bustling market for them.
So high liquidity, that's a plus.
It is. It is.
What about appreciation?
Okay.
Did railroad bonds have the potential to grow in value?
So here's where American railroads had a trick up their sleeve.
Okay.
Unlike British railroads,
Yeah.
which tended to pay out all their earnings as dividends,
Right.
American railroads often plowed
Okay.
a significant portion of their earnings
Right.
back into the business.
So they were basically investing in themselves,
They were.
improving infrastructure,
Yeah.
upgrading equipment.
Uh-huh.
That all adds up to
That's
a
right.
more valuable company.
Exactly. And the source gives us some numbers
Okay.
to back this up.
Back in 1906, the total debt
Yeah.
of U.S. railroads
Okay.
was less than 63%
Wow.
of the total market value of their assets.
Okay.
And get this,
Yeah.
even after railroad stock prices took a tumble in 1908, the debt was still less than 60%.
So even when the market got jittery,
Yeah.
there was a solid buffer
There was.
built in.
Yeah,
Those railroad bonds were backed by real assets.
precisely.
Yeah.
And when you look at their ability
Yeah.
to make interest payments,
Uh-huh.
the picture gets even more impressive.
Okay.
In 1906,
Mhm.
the net earnings of U.S. railroads
Okay.
could have been chopped in half,
Wow.
and they still could have made their interest payments.
Wow. So that sounds like a pretty strong indicator of financial health.
Indeed.
Okay.
Now, when you're looking at bonds,
Mhm.
you'll often come across this concept called basis.
Basis, fill me in.
Okay, so think of it as the net return.
You can expect from a bond,
Mhm.
taking into account the price you pay for it
Okay.
and how long until it matures.
So it's not just about the interest rate on the bond.
Right.
It's about how much you're actually earning
Exactly.
over the life of that bond,
Yeah.
considering how much you paid for it.
Precisely. It's like comparing apples to apples.
Right.
Even if the bonds have different interest rates
Yeah.
and maturity dates.
Okay, that makes sense.
Good.
Now let's switch tracks
Right.
and talk about real estate mortgages.
Okay.
So mortgages could offer really, juicy returns,
They could.
but they had a major drawback.
What's that?
They were notoriously hard to turn back into cash.
Right. You can't exactly list a
Yeah.
chunk of your mortgage
Yeah.
on the stock exchange.
Exactly, yeah. Low liquidity.
Precisely.
Okay,
And here's another interesting quirk
Yeah.
about mortgages.
okay.
Unlike stocks and bonds,
Mhm.
where an increase in the underlying property value usually benefits the investor.
Right.
The holder of a mortgage doesn't directly benefit.
But hold on, so if the property value goes up,
Yeah,
the mortgage holder doesn't get a piece of that.
not directly, no. But here's the kicker.
Okay.
They still bear most of the risk
Oh, wow.
if the property value tanks,
So limited upside,
right?
but plenty of potential downside.
That's the inherent
Yeah.
imbalance of a mortgage
Okay.
from the lender's perspective.
Okay. Now, I've heard of these things called
Yes.
guaranteed mortgages.
Mhm.
They're supposed to offer more protection, right?
That's the idea.
Yeah.
They're basically real estate mortgages that are backed by a third party,
Okay.
usually a financial institution
Right.
with, deep pockets.
So if the borrower defaults,
Yeah.
the guarantor steps in and
Yeah.
covers the losses.
Exactly. But our vintage source raises some valid questions
Okay.
about these guarantees.
Right.
First,
Yeah.
it wonders how far the guarantor's funds would actually stretch
Okay.
if the real estate market took a nosedive
Right.
and a bunch of borrowers defaulted at once.
So it's like, sure, they have deep pockets,
Yeah.
but are they bottomless?
Right.
Yeah, what if everyone needs a bailout at the same
That's it,
time?
right. And second, the
That's
source points out that these guaranteeing companies
Yeah.
have mostly been operating
Okay.
during times when real estate was booming.
Okay.
So their track record hasn't really been tested.
Okay, so it's like a fair weather friend.
Right.
They might be there for you when times are good.
Yeah.
But who knows if they'll stick around
Right.
when things get rough.
That's a good way to put it.
Okay. So
Yeah.
while those guaranteed mortgages might seem like a safe bet,
Mm-hmm.
it's important to really carefully evaluate the guarantor and the terms
Yeah.
before assuming they're a foolproof investment.
For sure.
Okay, noted. So let's move on to another category.
Okay, which one?
Industrial bonds. And I'm guessing they're a bit more complex to wrap our heads
Oh, yeah.
around because they're tied to the ups and downs of
Yeah.
specific
Yeah.
companies and industries.
You're absolutely right.
Okay.
So to assess the safety of an industrial bond,
Right.
you need to have a good understanding
Yeah.
of the business itself
Right.
and the overall
Yeah.
industry landscape.
Okay, so double the homework.
Yeah, essentially.
Got it. What key areas
Okay.
did our vintage source highlight
Yeah.
for evaluating industrial bonds?
So they pointed to 5 key areas.
Okay.
First up,
Mm-hmm.
the value of the real estate.
Yep.
Just like with those railroad bonds we talked about.
Right.
If an industrial bond is secured
Yeah.
by a first mortgage on a valuable piece of property,
Okay.
that's a really good starting point.
Okay, so it means there's a tangible asset that the bondholders could potentially
Yeah.
seize and sell
They could.
if the company goes belly up.
Yeah,
Okay, little insurance built in.
exactly. A little bit of insurance.
Yeah.
But you don't want to stop there.
Okay.
Next, you need to dig into
Yeah.
the company's working capital.
Working capital.
Yeah, this is all about their ability
Okay.
to meet their short-term
Right.
financial obligations.
So can they pay their bills?
Yes, exactly.
Make payroll?
Mhm.
Keep the lights on?
Yes, keep the lights on.
Okay.
So you're looking at their financial fitness, not just their asset.
Got it.
Precisely.
Okay.
The source emphasized the importance
Mhm.
of what they call net quick assets.
Okay.
And these are basically the company's most liquid assets.
Right.
So things like cash on hand or assets that can be
Yeah.
quickly converted to cash
Right.
minus their short-term liabilities.
So we're checking their emergency fund.
We are.
Do they have enough cash on hand to cover their short-term debts if things get tight?
That's the gist, yeah.
Yeah.
And ideally,
Okay.
their bonded debt
Yeah.
shouldn't exceed
Okay.
their net quick assets.
So healthy cash flow
Yes.
is crucial.
It is, yeah.
Makes sense. What else should we be looking at?
Profitability. You want to see those net earnings stable and ideally increasing over several years.
So are we talking about making sure they're actually making money?
Yes, we are.
Okay.
And our source suggested
Yeah.
that net earnings should be at least 3 times greater.
Wow. 3 times.
3 times.
Okay.
Than the combined annual bond interest, taxes, and any sinking fund payments.
Whoa. Okay, that's a pretty high bar.
It is, and it underscores the importance of a solid profit margin.
Okay.
It gives the company that cushion to
Right.
meet those debt obligations,
Yeah.
even if there's a few bumps in the road.
Right.
Okay, so
Solid profits. Checked.
check.
What's the fourth factor?
All right, so the fourth
Yeah.
is the structure of the bond issue itself.
Okay.
Is it a long-term bond
Yeah.
that matures, say, in 20 years?
Oh, okay.
Or is it structured as a serial bond issue
Mhm.
with different chunks
Uh,
maturing at different times?
and why does that matter?
Well,
Yeah.
because over the long haul,
Yeah.
the value of a company's assets can depreciate.
Right.
Wear and tear, obsolescence, that sort of thing.
Right. Right.
If that happens,
Mhm.
it could leave the bond
Yeah.
without enough of a safety net.
So if the company's assets lose value,
Yes.
the bondholders could be left holding a
Yeah.
much riskier
Yeah.
investment.
That's the risk. And that's why the source recommended
Yeah.
that if a bond has a long maturity,
Okay.
there should be a sinking fund in place.
Sinking fund. Now, there's a term I haven't heard before.
So a sinking fund
Yeah.
is basically a pool of money
Got it.
that the company sets aside
Right.
each year
Yeah.
to gradually buy back
Okay.
and retire
Mhm.
a portion of their outstanding bonds.
So even if the company's assets lose value,
Mm-hmm.
the sinking fund helps ensure
Exactly.
that the bondholders
Yeah.
eventually get their money back.
Exactly. It's like a
Like a safety net.
safety net
Yeah.
built
Is
into
right in?
the bond structure.
Yes, exactly.
Smart.
Yes.
Okay, we've covered 4 key areas
Okay.
for evaluating industrial bonds:
Right.
real estate value,
Yep.
working capital,
Huh.
profitability,
Mm-hmm.
and the structure of the bond issue.
Right.
What's the 5th and final factor?
This one might sound familiar,
Okay.
but it's absolutely crucial.
Okay.
Management
Okay.
and control of the company.
Okay. I'm sensing a pattern here.
Yeah.
We talked about the importance of good management
Yeah.
with railroads,
Yeah.
and I bet it comes up again.
It will with other investments.
Yeah, you're picking up on a key theme here.
Okay.
The competence,
Yeah.
the ethics,
Right.
the overall track record of the people running the show.
Yeah.
It all matters.
Yeah. It's like the old saying, a
Right.
bad captain can sink a good ship. Right?
Exactly.
Yeah.
You want to invest in companies
Right.
with leaders you trust,
Right.
leaders with experience
Yeah.
and a proven ability to navigate challenges.
So industrial bonds are like a high maintenance relationship.
Yeah, they are.
You need to be sure
You do, yeah.
about the company,
Yeah.
the industry,
Mm-hmm.
and the people in charge.
You got it.
No wonder those early 20th century investors
Yeah.
were so careful.
They had good reason to be.
Yeah.
So that wraps up
Yeah.
the 5 key areas
Mm-hmm.
our source highlighted for
Yes,
evaluating
shame.
the safety of industrial bonds.
Right.
But remember, safety is just one piece of the
Oh.
puzzle.
Okay.
We also need to consider
Yeah.
the rate of income
Right.
and convertibility.
Right. Because a safe investment isn't much good
Right.
if it's not generating a decent return.
Exactly.
Or if you can't access your money
Right.
when you need it.
Precisely. Now, according to our source,
Mm-hmm.
industrial bonds tended to offer a higher average rate of income.
Ooh. Higher potential return.
Yes, higher returns.
But I'm guessing that comes with
Technically.
higher risks too.
That's usually the trade-off.
Okay.
And as for convertibility,
Yeah.
it really boils down to the
Right.
specific bond
Yeah.
issue.
Okay. Break that down for me.
So larger bond issues
Mm-hmm.
from well-established companies,
Okay.
especially those that are actively traded
Right.
on a market,
Yeah.
tend to be more convertible.
Okay.
It's easier to buy and sell them
Right.
without drastically affecting the price.
Got it. So those are more liquid,
Yes.
just like those railroad bonds we were talking about.
You got it.
Okay.
But smaller bond issues
Sure.
or bonds from lesser-known companies
Mm-hmm.
might be a lot harder to sell.
Because there just aren't as many
Right.
buyers and sellers out there.
Exactly.
Makes sense.
Yes.
And I'm guessing this difference in convertibility
Yes,
affects
it does.
both the price stability
Yeah.
and the potential for appreciation, right?
You're absolutely right.
Okay.
Less convertible bonds
Yep.
might have less stable prices
Mm-hmm.
because there aren't as many transactions happening
Right.
to establish a clear market value.
So the price could be more susceptible
Got it.
to like rumors, speculation, or even just like the whims of
Right.
a few buyers and sellers.
Exactly.
Yeah.
And when it comes to appreciation,
Okay.
those more convertible bonds,
Right.
especially those from companies
Yeah.
that are thriving and growing,
Mm-hmm.
tend to have more room
Yeah.
to grow in value.
Right, because as the company's outlook improves,
Mm,
more investors want a piece of the pie, right?
exactly.
And they're willing to pay a premium to get in on the action.
Supply and demand.
It's simple
Yeah.
supply and demand.
That's the general idea.
Okay.
Now, our source also touched on
Oh,
one
yeah,
final
yeah.
aspect of
Yeah.
industrial bonds,
Yeah.
the stability of their market price.
Okay, I'm all ears. Tell me what those savvy early 20th century investors
Yeah.
had to say about that.
Well, they noted that industrial bonds, their prices were more likely to, react to changes in the overall business outlook.
Okay.
Shifts in interest rates,
Right.
or even just general market jitters.
So if you're someone who like prizes stability and
Yeah.
predictability,
Uh-huh.
industrial bonds might not be your cup of tea.
That's a fair assessment.
Mm-hmm.
They're generally a better fit
Okay.
for investors who are comfortable with
Yeah.
a bit more risk.
Right. And who are looking for potential capital growth.
Exactly.
Okay, that makes sense. So we've covered a lot of ground on bonds,
We have.
from railroads to equipment to
Okay.
industrial.
Indeed. And in part 2,
Okay.
we'll shift gears and
Oh.
explore another
Oh.
crucial piece of the investment puzzle,
Okay.
public utility bonds.
Public utilities. Okay.
Yes.
That sounds a
Yeah.
little,
What do you think?
I don't know, mundane.
Really?
Aren't we talking about like power companies and waterworks?
Well, don't be fooled by their everyday nature.
Oh, okay.
Public utility bonds
Yeah.
have their own
Follows it.
unique set of considerations.
Okay.
Our source material really hammered home
Okay.
the importance of really digging into
Yeah.
the franchise agreement that underpins
Mhm.
these companies.
Okay. You've piqued my curiosity.
Good.
Why is this franchise agreement
Well,
so critical
Yeah.
when it comes to evaluating a public utility bond?
it all boils down to
Uh-uh.
control and
Uh-uh.
stability.
Okay.
The franchise agreement is basically a
Yeah.
contract
Right.
between the utility company
Mhm.
and the local government.
Right.
It gives the company the right
Yeah.
to operate
Uh-huh.
and provide services.
Okay, so electricity.
Gas, water,
Electricity.
gas, water,
That, all the essentials. Yep.
within a specific area.
Exactly.
So it's like their permission slip
It's
to do
fine.
business.
Exactly. And the terms of that agreement can
Yeah.
make a big difference
Okay.
in the company's profitability and overall stability,
Right,
which in turn directly impact
right.
the safety of their bonds.
Makes sense. What specific parts
Okay.
of the franchise agreement should investors be looking at?
Our source highlighted a few key points.
Okay.
First, you want to look at the duration. Yep.
Of the franchise.
Okay.
Is it perpetual, meaning it lasts forever?
Right.
Or
Yeah.
is it for a limited time?
Okay, so 25 years.
25 years.
50 years?
50 years.
Something like that.
Something like that.
Yeah.
Okay, I can see why that matters.
Yeah.
If the franchise expires
Yeah.
before the bond matures,
Right.
that creates a lot of uncertainty.
It does.
Will the government renew it?
Right.
Under what conditions?
Yeah.
You know, all those unknowns
Yes.
could make the bond riskier.
They could.
Yeah.
Ideally, you want the franchise to be in effect.
Okay.
At least as long as the bond's maturity date.
Okay.
That way, there's no surprises.
Right. All right.
Another key factor is
Yeah.
whether the franchise is exclusive
Right.
or non-exclusive.
So exclusive means they're the only game in town.
Exactly.
Right. No competition.
Exactly. An exclusive franchise
Mhm.
is obviously more valuable.
Because it guarantees
Mm-hmm.
a steady stream of customers.
Makes sense.
A non-exclusive franchise, on the other
Oh, yeah.
hand, means the company could
Yeah.
face competition.
Right. Which could potentially eat
Yeah.
into their profits.
Exactly.
Okay. So duration.
Duration,
Okay,
exclusivity.
Got it.
Okay. Anything else?
Is there anything else we should be like scrutinizing
Yes.
in this franchise agreement?
Our source also mentioned the importance of understanding,
Yeah.
you know, all the details
Right.
of the agreement.
Right.
Things like regulations
Mhm.
around setting rates,
Okay.
service quality standards, and capital investment requirements.
Because those factors could impact
It could.
the company's expenses and
Exactly.
how much revenue they're bringing in.
You got it. But beyond the legal and financial fine print,
Yeah.
our source emphasized
Okay.
the importance of considering the political climate.
Okay. Now things are getting interesting.
Yeah.
What kind of political dynamics do we need to be aware of?
Well, these public utility companies
Yeah.
operate in a world of regulations,
Uh-huh.
and local governments often have a big say
Right.
in how they run their business.
So things like, raising rates, expanding service areas,
Yeah.
even adopting new technologies. I imagine that
Well-
all has to go through a political approval process.
That's right. And
Yeah.
the relationship between the utility company
Mm,
and the local government
right.
isn't always
Well,
smooth
yeah.
sailing.
So investors need to be political analysts
Yeah.
as well as
In a way,
financial analysts.
it's about understanding the lay of the land.
So is the local government generally
Yeah.
supportive of the company's plans?
Yeah, right.
Or are there like simmering tensions and disagreements
Right. That could lead to
that could lead to
delays,
Yeah.
roadblocks,
Yeah.
or unfavorable regulations.
Okay, so we've got the big picture,
Yeah.
the franchise agreement,
Okay.
the political landscape.
The political landscape. Yeah.
Now let's zoom in on the financial nitty-gritty.
Okay.
I bet our early 20th century source had some specific metrics they like to use to evaluate public utility bonds.
So one of the most important
Okay.
was the company's net earnings,
Net earnings.
their bottom line profitability.
Okay. So
Okay.
are we talking about making sure they're actually making money?
We are. We are. And our source had a
Yeah.
rule of thumb.
Okay.
Net earnings
Yeah.
should be
Yeah.
at least twice the amount
Yeah.
of the interest charges
Right.
on the company's outstanding bonds.
So a healthy profit margin
Yeah,
to comfortably cover
that's right.
those interest payments,
Mhm.
even if there are some unexpected expenses.
Yes, exactly.
there-
It provides
Yeah.
a cushion of safety.
Okay.
But here's another important wrinkle.
Right.
When analyzing
Yeah.
net earnings, depreciation.
Okay, depreciation. That's one of those accounting terms
Yeah.
that always makes my eyes glaze over a little bit.
It's really not that complicated.
Okay, remind me.
Okay, so depreciation reflects
Yeah.
the wear and tear
Okay.
on the company's physical assets.
Okay.
So power plants,
Mm-hmm.
pipelines,
Right.
equipment,
Right.
all that stuff.
Yeah.
That's essential to their operations.
Okay.
All those assets have a limited lifespan,
Mm-hmm.
and their value
Right.
gradually goes down over time.
Okay, so depreciation is basically a way to spread the cost
Yeah.
of those assets
Yes.
over their useful life.
That's the gist. And it's really important to
Profit.
factor that in
Yeah.
when you're assessing
Yeah.
their true profitability.
Okay, I'm intrigued. Why?
Depreciation matters so much.
If a company isn't setting aside enough money
Okay.
to cover depreciation,
Right.
it might look more profitable on paper
Okay.
than it actually is.
Okay.
They could be delaying essential maintenance or
Right.
upgrades.
It's like neglecting to change the oil in your car.
That's a great analogy.
You might save a few bucks now,
Yeah.
but eventually
Yeah.
that engine is going to seize up.
Exactly.
You want to see
Yeah.
that the company is properly
Yeah.
accounting for depreciation
Yes, and investing.
and investing in those long-term
Yeah.
assets.
It's a sign of responsible management
Okay,
and a sustainable business model.
got it.
Good.
So we've looked at
Mm.
the franchise
The
agreement,
franchise
the
agreement,
political land,
the political landscape.
the company's net earnings,
Mhm.
and the importance
Yeah.
of considering depreciation.
Anything else
Don't forget
we need to keep in mind?
the human factor.
Okay.
Our source material stressed that the quality of management
Yeah.
is always a critical factor.
Right, because you're not just evaluating, their
Mhm.
business savvy.
Right.
You're looking at their
Yes.
ability to navigate
Right.
those complex
Yeah.
regulatory environments
So that's right.
we talked about.
Exactly. Can they build
Oh.
and maintain
Yeah.
strong relationships
Mhm.
with regulators?
Right.
Can they effectively represent
Yeah.
the company's interests
Right.
while also balancing the
Yeah.
needs of the community?
Okay.
These are all
Um,
important traits to look for.
It seems like evaluating public utility bonds
It does.
requires a pretty multifaceted approach.
It does.
You've got to understand
It does.
the legal framework of the franchise agreement,
Mm-hmm.
the financial health of the company,
Right.
the political winds blowing in the background,
Yes.
all while keeping a close eye on the quality of the people
That's right.
at the helm.
You got it.
Okay.
It's not a simple investment to analyze,
Right.
but if you do your homework,
Yeah.
public utility bonds can offer
Okay.
a solid combination
Yeah.
of safety, yield,
Mhm.
and stability.
Okay, challenge accepted. I'm ready to tackle the next category on our list.
Which one is next?
Municipal bonds.
Okay.
I'm particularly interested in this one
Okay, right.
because our source material
Mhm.
made a big deal about the unique security behind these bonds, the
Yeah.
power of taxation.
That's right. Municipal bonds
Okay.
are fundamentally different
Yeah.
from corporate bonds in that
Yeah.
they're backed by the taxing authority
Okay.
of the issuing municipality.
So, be it a city,
A city,
a town,
or a county.
or a county. Yeah.
So instead of relying on...
The profits of a company,
Yeah.
these bonds are secured
Wait.
by the government's ability
Yes.
to collect taxes from its citizens.
Exactly. And as long as the municipality remains
Mhm.
financially stable,
Right.
the bondholders
Yeah.
are pretty much guaranteed to receive their interest
Uh-huh.
and principal payments.
So it's like having the power of the tax man
It is, yeah.
backing your investment.
Exactly.
That does sound pretty secure.
It is.
But how do you actually evaluate
This is
the
okay.
financial strength
Yeah.
of a city or a town?
Okay, so our source suggested a
Yeah.
few key areas
They
to
did.
focus on.
Okay.
First, you want to look at
Okay.
the ratio
Uh-huh.
of the municipality's total debt
Okay.
to the assessed value
Right.
of all its taxable property.
So all those homes and businesses
Yeah, all the assets
and other assets.
within its jurisdiction.
So we're basically trying to figure out how much the town owes compared
Yes.
to the value of everything.
The value of everything
Okay.
it can tax.
That's the idea. A high debt to assessed value ratio
Okay.
can be a red flag
Right.
because it suggests
Yeah,
that the
yeah.
municipality might be stretched thin
Okay.
and could have trouble
Yeah.
meeting its financial obligations.
Makes sense. What other financial clues should we be looking
The
for?
purpose of the bond issue
Okay.
is also important.
Okay.
You want to make sure the money is being used for
Yeah.
legitimate public projects
Right.
that will genuinely benefit the
Yeah.
community
Right.
and ideally boost its economic prospects.
So like building new schools,
So school
upgrading infrastructure,
infrastructure.
investing in public safety, those would all be seen as
positive uses
positive uses
of bond proceeds.
right, projects that projects that
Improve the
quality of life and attract
new residents or businesses. Yeah.
Yeah, it means the
Okay.
municipality
Mhm.
is thinking about
Right.
the long term
Right.
and making investments
Yeah.
that will pay off.
And what about projects that seem, I don't know, less essential
Right.
or even like wasteful?
Yes,
Would those raise red flags?
definitely.
Okay.
If a municipality is using bond proceeds
Yeah.
to fund, say,
Right.
extravagant projects or
Right.
pet projects
Yeah.
that don't offer
Yeah.
a clear public benefit,
Yeah.
that's a sign to be cautious.
Okay.
It could indicate
Yeah.
a lack of fiscal responsibility.
So it's not just about
It's
not
not
understanding the numbers. It's
Yeah.
about understanding
It's about understanding
their priorities
Yeah.
and whether they align
Exactly.
with the long-term well-being of the community.
Precisely.
Yeah.
And the last point
Mm-hmm.
our source emphasized
Yeah.
is the importance of ensuring
Okay.
that the bond issuance process itself
Right.
was all above board.
Right. Because if there are any legal snags
Yeah.
or shady dealings,
Right.
that could put the whole bond issue
It could.
in jeopardy.
Exactly.
Correct.
Investors need to make sure
Yeah.
the municipality dotted their I's
Right.
and crossed their
Yeah.
T's
Yeah.
when it comes to the legal paperwork.
Okay. I'm getting a crash course in municipal finance here.
Good, good.
Now, our
Please.
source also
Yeah.
drew a distinction between
Yeah.
active and inactive
Right.
municipal bonds.
Right.
What's the difference?
It basically comes down to liquidity.
Okay.
You know, that concept
Yeah.
we talked about.
Yeah. How easy it is.
Yeah, how easily you
Or
can
buy and sell.
buy and sell a particular investment.
So active municipals.
They're like those liquid railroad bonds we discussed.
Yeah.
Easy to trade on the market.
Easy to trade. Yeah.
Inactive municipals
Yeah.
are a bit more like those illiquid real
Yeah.
estate mortgages.
That's a great way to think about it.
Okay?
Active municipals
Yeah.
are typically issued
Mm,
by
yeah.
larger,
Right.
well-known municipalities
Okay.
that have a significant amount
Mhm.
of outstanding debt.
Okay.
These bonds
Yeah.
are
Yeah.
frequently traded,
Right.
making them a good fit
Right.
for investors who value flexibility.
Right.
They want to be able to
Yeah.
easily adjust their portfolio.
That makes sense.
Yeah.
But why would anyone
Okay.
choose an inactive municipal bond
Yeah.
if it's harder to sell?
Well,
What's the appeal?
they often offer a higher yield
Okay.
to compensate
Right.
for that lower liquidity.
Right. It's like getting paid a premium.
Except for being willing to
Yeah.
tie up your money
Tie up your money
for a longer period.
for a longer period. Yeah.
Okay.
And as our source pointed out,
Mm-hmm.
sometimes those inactive municipal bonds
Okay.
can really come in handy
Okay.
when the market hits a rough patch.
Really?
Yeah.
Tell me more. How can
Um,
a less liquid investment
Yeah.
be a good thing?
So our source told a story
Okay.
about how inactive municipals
Mm-hmm.
actually played a role in rescuing savings banks
Wow.
during a financial crisis.
Okay.
When the value of many investments, particularly those more volatile
Mm.
railroad bonds,
Right.
plummeted,
Okay.
the relative stability
Right.
of those
Yeah.
less traded municipal bonds
Right.
provided
Yeah.
a much needed anchor
Okay.
for the bank's portfolios.
Yeah.
They helped to
Mm.
stabilize the
Yeah.
financial system.
So in that case,
Yeah.
being a bit illiquid
Uh-huh.
actually provided a safety net.
It did. It did.
It's a good reminder
Yes.
that diversification is key
It is.
and that sometimes the investments that seem
Yeah.
less appealing in good times
Yeah.
can really shine when the going gets tough.
Exactly. It's all about understanding the trade-offs
Yeah.
and building a portfolio
Yeah.
that can handle a variety of
Yeah.
market conditions.
Okay, so we've explored public utilities and municipal bonds,
Yes.
two investment categories that might seem a bit boring at first glance,
It might.
but actually involve quite a bit of nuance and complexity.
Indeed.
Now it's time to tackle the final frontier of our
Exciting.
vintage investing guide.
All right. Bring on the stocks.
That's where things start to feel
Yeah.
a bit more like Wall Street, right?
They do.
Big risks, big rewards.
Yeah.
You're catching the spirit.
Okay.
But remember,
Yeah.
we're still looking at stocks through the lens of those
Okay.
early 20th century investors.
Right.
They had a very specific way
Oh,
of
cool.
approaching these investments,
Right.
and their insights
Yeah.
are still relevant today.
Okay, I'm ready for a history lesson.
Good.
Wall Street twist.
All right.
What did those old school investors have to say about stocks?
Well, one of the most striking things our source pointed out
Right.
was that even back then,
Okay.
the view of stocks was starting to shift.
Okay.
Court decisions
Yes.
were starting to limit returns on stocks
Okay.
to what they called a fair investment basis.
Fair investment basis. Huh?
Yeah.
What does that even mean?
So up until that point,
Okay.
the prevailing view
Yeah.
was that investors in stocks
Right.
were entitled to, unlimited profit.
Right. Right.
But these court decisions,
We're signaling a change in thinking a move towards aligning returns
okay.
with what was considered a reasonable level
yeah.
of risk.
So instead of like the Wild West of unlimited potential riches,
Yeah.
they were trying to inject a bit
Sure.
more
Yeah.
fairness and balance into the system.
Precisely.
Oh,
And
yeah?
this shift had some interesting implications
Yes. What?
for investors.
Okay.
Well,
yeah.
it essentially created a new risk profile
Okay.
for stockholders.
Right.
Their potential upside
Yeah.
was now capped,
Right.
but their potential losses
okay
weren't.
So they were taking on the same level of risk,
Yeah.
but with less potential reward.
It seemed that way.
That doesn't seem like a very good deal.
Well, it was a growing concern at
Like-
the time. It was an early sign
Okay.
of things to come,
Okay.
as regulations and public sentiment
Yeah.
sought to balance the interests of investors
Uh-huh.
with,
Yeah.
the broader public good.
So it's like the beginning,
It was.
this tug of war
yeah.
between those who wanted unfettered capitalism
Yeah.
and those who wanted more rules and protections in the market.
That's a good way to put it. And that
Okay.
tension continues to shape
Right.
the investment landscape today.
Now, amidst all this talk about changing attitudes towards stock profits,
Right.
our source pointed out an interesting exception to this trend:
What's that?
bank stocks.
Yes. Bank stocks
Yeah.
were a bit of an anomaly
Okay.
at the time.
Okay.
You see, they often retained a
Mhm.
large portion of their earnings
Okay.
rather than,
Yeah.
distributing them to shareholders as dividends.
Right.
So they were holding on to
They were there
their profits
Mm.
instead of...
sharing the wealth
Right.
with shareholders.
Yeah, why would they do that?
Okay.
Well, it was a strategy for
Mm.
growth and stability.
Okay.
By reinvesting those earnings
Yeah.
back into the business,
Right.
they were able to steadily increase
Okay.
their book value,
Okay.
the difference between
so-
their assets
Mm.
and their liabilities.
So instead of giving shareholders a quick payout,
Yeah.
they were focusing on
Yeah, yeah.
building the long-term value
Yes,
throughout
exactly.
the company.
And this approach
Okay.
had a couple of
Yeah.
key benefits for investors.
Okay.
First, it
Yeah.
led to a more stable and
Mhm.
predictable
Yeah.
stock price.
Yeah.
You see, those reinvested earnings
Right.
provided a solid foundation for growth,
Right.
which reduced the volatility that often came
Yeah.
with more speculative stocks.
So bank stocks were seen as
It's kind of a safe haven.
especially during those turbulent times
Time.
when,
Yeah.
the view of stocks was
Right.
in flux.
Okay.
And second,
Yeah.
those reinvested earnings had a compounding effect.
Okay.
As the bank's book value grew, so did its earning power,
Right.
which fueled further growth
Yeah.
and increased the value of the stock
Yeah.
over time.
So for those patient investors
Yes.
who are in it for the long haul,
Exactly.
bank stocks offered a way to participate in the growth
Right.
of a stable and essential
Like, right.
industry,
Mm.
while also, benefiting from that magic.
The magic of compounding.
And compound.
Precisely.
Yeah.
It provided a way
Okay.
to build wealth
Yeah.
gradually and
Mhm.
steadily
Right.
with less risk
Yeah.
than some of those.
More speculative ventures.
Okay, I'm starting to see
Yeah.
why those
Hmm.
early 20th century investors
Right.
were so drawn to bank stocks.
Yeah, they were looking for that balance.
Right, that balance of
Like-
growth
And security. Bank stocks seem
Yeah.
to fit the bill.
It's a great observation.
Okay.
Now, I know we've been focusing on,
Mhm.
the historical
Right.
perspective here.
Yeah.
But it's important to remember
Right.
that the world of stocks
Yeah.
has changed dramatically
It has.
since the early 1900s.
Right. We've got online trading platforms,
Yeah.
instant access to information,
Uh-huh.
a whole universe
We do.
of investment options
Yeah.
that those early investors couldn't have even dreamed of.
Exactly. But here's the thing.
Okay.
Even though
Yeah.
the tools
Right.
and the landscape
Yeah.
have changed,
Right.
many of the fundamental principles.
Of evaluating stocks remain
Yeah.
surprisingly relevant.
So even in today's fast-paced,
Yes.
tech-driven market,
Yeah.
we can still learn from the wisdom
There
of
you
those
go.
old school investors.
Absolutely. Their focus on
Yeah.
understanding a company's financial health,
Okay.
their management team, and their long-term
Right.
growth prospects
Yeah.
is still the foundation of sound stock investing.
Okay. That's reassuring.
It is.
Seems like the more things change, the more they stay the same.
That's true. That's true.
So as we wrap up our deep dive
Yeah.
into this treasure trove of
Yeah.
vintage investing advice,
Right.
what are the key takeaways
Okay. So
for our modern day listeners who
Yeah.
are navigating the complexities of
Yeah.
today's market?
I think the most important lesson
Yeah.
is that
Mhm.
investing
Mhm.
is not a one-size-fits-all endeavor. Just
Yeah.
like those early investors,
Right.
you need to take the time to understand your own financial goals, your risk tolerance, and the characteristics
Right.
of
Yeah.
different investments.
So it's not about, blindly following trends or
No.
chasing the latest hot stock tip.
No, it's about crafting a personalized
A personalized investment strategy.
business strategy. Yes,
Right. Yeah.
that aligns with your
Yeah.
unique circumstances
Right,
and
right.
aspirations.
I love that.
Good.
We've given our listeners a historical roadmap here, but
Yeah.
it's up to them
It is.
to chart their own course
Absolutely is.
through this exciting
Yeah.
and ever-evolving
It is, yeah.
world of investing.
Indeed. We've unearthed those timeless principles.
Yeah.
We've shared the stories of triumphs
Right.
and failures,
Yeah.
and we've highlighted the importance of adapting to a changing landscape.
Right.
Now it's time for our listeners
Yeah.
to take the reins, embrace the adventure,
Yeah.
and make their own mark
All right.
on the world of investing.
Well said. Happy investing, everyone.